Welcome to the latest video from the Institute of Economic Affairs with me, Syed Kamall, the Academic and Research Director at the IEA. I'm also a Professor of Politics and International Relations at St Mary's University in Twickenham. Now, after the last financial crisis, we saw a slew of regulation to ensure that our banks were better capitalised. And in the light of the impact of coronavirus on the economy, a recent IEA briefing paper, How Strong Are British Banks?, examines the Bank of England's claims that UK banks are so strongly capitalised after the global financial crisis that they could go through an even worse event and still emerge in good shape. The paper's authors argue that evidence from share prices and market values suggests that the opposite may be true. They argue that the Bank of England has failed to ensure banks have strong capital buffers ahead of the COVID-induced downturn. Now, I'm delighted to be joined by the authors of this briefing paper, Kevin Dowd, Professor of Finance and Economics at Durham University, and Dr. Dean Buckner from the UMIAS project, which describes itself as keeping an eye on the palaces of the financial system. Kevin and Dean, thank you both very much for joining with me today and indeed for writing the paper. So let's start with you, Kevin. Could you start by telling our viewers why you decided to write this paper? And if we're on the cusp of a banking crisis, why isn't this issue being given more attention?
Well, the reason we wrote this paper was because I have a long-standing interest in the capital adequacy of British banks, and I've long felt that the Bank of England's narrative that banks are strongly capitalised was extremely misleading. In essence, the bank is peddling a false narrative that everything is just fine. It's a very comforting narrative, but it's based on very misleading capital ratios and misleading metrics, basically. So I think the whole narrative has to be tossed in the bin. We have to look at it more sensible narratives. More sensible metrics that are less gameable and more robust.
Dean, Kevin's very much looking at this as a professor of finance, who's had a long interest in this subject. You're a former prudential regulator. What motivated you to get involved in this, writing this paper?
Well, I've been interested in the subject, just as Kevin is. I've not been working in capital adequacy quite as long as Kevin, but I'd say for the last 25 years, I've done this for a living. I worked at the FSA, then the PRA, then the Bank of England, looking at both banking and insurers' capital adequacy. So it's a subject dear to me. And like Kevin, I have strong views on the virtue of a book value of capital versus the market value of capital.
So, Kevin, we see in the book or the paper that the core metrics of the big 5 UK banks have deteriorated sharply since the new year, and even more since the end of 2006, the eve of the global financial crisis. Could you go into a little more detail on the situation as it stands?
Okay, so the two key metrics. The first metric is leverage. So banks currently, leverage is the ratio of the bank's total assets to the market capital. And the current leverage of UK banks by that metric is about 45. So for every pound of equity of market capital the banks have, they've got 45 pounds in assets. That's a lot of leverage. And that is 5 times the leverage of the UK banks going into the financial crisis. Everybody agrees that excess leverage was a big problem affecting the severity of the last crisis. So I'm very concerned about that. The second key metric, key thing to look at is the price to book ratio of the banks, which is the ratio of the bank's book value to their market value. Now, if you have a healthy banking system, the price to book ratio should be comfortably in excess of 100%. The current price to book ratio of British banks is 38%. So it's well below water. And that means basically that UK banks are value destroying entities.
So, Dean, if banks are as fragile as the paper suggests, how come they are still there? How come they've remained so resilient thus far? The economy seems to have fallen off a cliff, yet the banks are still standing. What explains that?
Okay, well, the first thing is, what does it mean for a bank to collapse? And it takes a while. I mean, it takes a very long time for insurance companies to collapse, decades. Banks now, I remember working at the FSA in 2007, and someone next to me was on the phone, and then when he got off the phone, he said, "Oh, there is a problem with bank called Northern Rock. That was in March 2007. That didn't really come to a head until, well, when was that? September 2007?
Yeah.
Around about then. Then Robert Peston gave that interview, didn't he? And then it all went horribly wrong. But that was not the end of it. It kept going on. Right through 2008, we were seeing March 2008, credit spreads exploded. Lehman was, that was around September, I think.
Yeah.
And a bit later, there was the HBOS. So these things do not happen all at once. Moreover, they may not happen. We don't know. It's still early days. We've seen massive spike in credit spreads in March with the virus crisis. Those have come in a bit, and the market's sort of looking a bit resilient. I wouldn't say the bank shares are looking resilient, but if you look at some companies, the FTSE is not doing too badly. So why hasn't anything really, really bad happened? Well, it could still happen because we haven't been into this crisis long enough, and it may not happen. But looking at banking shares and some insurance shares in the aftermath of the crisis, they're not looking so good. You compare HSBC or Lloyd's to the FTSE, for example, and that is not looking good at all. And in my view, and I think in Kevin's view, that market figure is telling you something. It's telling you the market is worried about the financial stability of banks.
So, now, Dean, Kevin mentioned the metrics, and they're no secret, if you like. The metrics of leverage and also the price to book ratio. So, given that these metrics are out there, how is it that the Bank of England has drawn such starkly different conclusions to your research? Its interim stability report in May found that the core system was resilient.
Right, that's an interesting one. I think the first thing to say is that the Bank of England, and with it the PRA, have the objective of financial stability and they call it the soundness and safety of banks, the financial institutions. That's their core objective, and rightly so. One of the ways you can preserve the apparent safety and soundness of banks is to get the right sort of numbers that appear to make these banks seem fully shipshape and in order. One metric, it's called risk-weighted assets, is a measure of leverage that makes it look much better than the metrics that Kevin has just given of leverage. And that, to some extent, in my view, is sort of a made-up number. So if these metrics give the sense that British banks are sound, then that's what everyone will think, and you've delayed any potential crisis. But the question is whether those metrics are realistic or not. They do not use market value of capital, they use the book value of capital, for example, which gives you a much better looking number. Kevin, I think, what were the ratios again for the price to book ratios?
Well, on average, it's 38%. And Barclays is about 27%, and HSBC 38%.
38%. So basically, the market metrics are telling you it's sort of between 30 and 38% of what the bank is saying it is, which is a big deal, right?
It's a huge deal.
Yeah.
So let me ask you both, and I'll start off with Kevin. If British banks are in a weaker position today than they were on the eve of the global financial crisis, a little over a decade ago, what can we expect to unfold in the coming months? I realise I'm asking you to look into a crystal ball here in many ways, and as we know, most forecasts by definition are wrong. But how do you see it unfolding in the coming months? Let's start with you, Kevin.
Well, I see the bank share prices continuing to erode. I've been kind of watching this with a certain morbid fascination. So the banks took a huge hit with the COVID crisis in March, and then they kind of bounced back. And I kind of wondered whether we're looking at a dead bat bounce here. And now they are now about as low as they've been. We see HSBC's share price is now the same as it was in 1996. And the collapse in share prices since 2006 is absolutely remarkable. For RBS, which is now rebranded as NatWest, we're looking at 98%. And for for HSBC, which is the better of all of them, we're looking at over 50%. So those are serious warning signals. So what do I think will happen? I think we'll see more of this erosion. We'll see a lot of extend and pretend, where we'll see the misapplication of accounting standards, subsumed to bank discretion and so forth. A lot of fiddling. Then we'll see, I think, some failures, and we'll certainly see some bailouts. And then we'll see a lot of hand-wringing and buck passing, and how could this ever have happened, and all the usual stuff. I'm sticking my neck out there. But.
No, good. I mean, we want you to stick your neck out. I mean, most people, lots of people make predictions. Dean, how about yourself? How do you see it unfolding in the coming months?
You see, I think the next big thing that we're going to be looking at, we're going to be seeing is defaults on loans. We've already seen some reports in the some of the half-year results of increasing provision for defaults. Again, there's a bit of massaging of the numbers here. There's a standard called IFRS 9, which allows you to hold the majority of your book, your loan book, as sort of good loans that can't possibly go wrong and attract a very light capital charge. We are worried, given the proportional size of that book compared to the sort of bad books, given that we're worried that there might be a lot of stuff lurking there. That hasn't come out now, but which may well come out in the next 6 months or the next 18 months. If you remember, HBOS collapsed from a fairly good position. It collapsed after it was discovered there was a very, very bad book lurking that even the accountants didn't know about. That came out close to when Lloyd's took over, and its share price collapsed to practically nothing. It was like a 99.9% collapse in share price. So I think the thing to watch very, very carefully is reserves for loans and reports of default and that kind of thing. Very difficult to tell, but my bet on the next bit of news is going to be that.
Okay, well, both of you, and I'll start off with you, Kevin. If you look at your report and your conclusions, your solution to the problem is to do away with the regulator, make bankers personally liable for the losses, and banks will soon sort themselves out. Now, given that you suggest that, and do you think that's achievable with the current political climate? What's the reality of that?
Okay. You have the Overton window. Our job as analysts, people who want to try and propose reforms, is to shift the Overton window. So to put it another way, I think the bankers are like the new trade unions. What we need is a new Mrs. T to sort them out. And we know that this will work because essentially what we're talking about is going back to the past, where you would have much greater liability, potentially unlimited liability for investment banks and so forth. We've had that into the 1980s, and we know that made the investment bankers prudent. So we have a solution that we know works. The question is the political will. Well, again, we'll just fumble around like we did with the unions for years and years and years before the right leader comes along and the reform will take place. The question is, how many of these cycles do we have to put ourselves through before this problem? Essentially, we're talking about the political economy of bank regulation, where the game is that the banks want to run down their capital to maximize return on equity, and the regulators ineffectively try to stop that because they're captured. So that's just bad regulation. It's never going to work. What we need is good governance. And the way we get that is by extended liability.
But Kevin, if I could just push you a bit on that, an opportunity for that sort of reform would have been after the last global financial crisis. And I know there are a number of people who are arguing that there should be director liability, that we should look at accounting standards. So, so you have to make provisions for bad loans and not be exposed to the sort of risk we saw AIG financial products exposed to. I think it was 2.8 trillion in the end. And also to make sure that we make it quite explicit that there will be no taxpayer bailout in the future. But that hasn't happened. If that didn't happen after the financial crisis, is it realistic that it will happen now?
Well, it depends when we decide we want to tackle it properly as a community. I mean, it's not for the want of trying. In 2012, I helped with Steve Baker put a private members bill exactly on this issue, which would have had strict unlimited personal liability for senior bankers. So if we go back to Britain now, we have people complaining about the unions in the 50s. We were making movies, laughing at them and so forth. It took Thatcher over 20 more years before finally the political constellation was in a position to do something about it. So how long it will take, I don't know. But I am convinced there is no other solution.
And Dean, do you agree with that, or are there any variations of that you would say suggest to mitigate the risks?
It's a theoretical solution that's going to take a long time. I don't disagree with it, but I'm not sanguine that will ever happen. In answer to the question why after the crisis nothing more was done, there's a sort of paradox here that the bank looked at the crisis. It first said it was a liquidity problem. Then a few years down the line, they said actually no, it was a solvency problem. Further on from that, there was a school of thought, and still is a school of thought in the bank that says, look, we overcame it thanks to our the valiant efforts of the central banks. It was all put right, so it's all fine. So it wasn't really a crisis after all. There's a big school of thought there in the bank and the central banks that you can fix things by just pretending everything's okay. Nothing really happened in the crisis. That blowout of credit spreads and market perception of default was just a false alarm. False volatility, as they call it. Just listen to us chaps at the central bank who know best. We're all from public school at Oxbridge. We know best. The markets know nothing. It'll all be fine. So paradoxically, the effect of the crisis was to reinforce this sort of patrician attitude within the Bank of England and its immediate environs that nothing really was wrong. Just trust us. We know best.
And so if it's going to take a long time to, as Kevin suggests, move in the Overton window, there's also another view that if you want to change things, you have to put that on the agenda. And I remember the IEA, for example, put on the agenda, I think even in the 50s, the idea of private competitive telecoms market when the telephone service was state-owned and run by the post office. It took about 50 years for that to come into fruition. What other actions do you suggest, Dean, given that if you were sitting as a regulator now, would you say that could be taken realistically to mitigate these risks?
Well, first of all, let's assume we've all agreed what the right thing to do is. We've listened to Kevin and others, myself perhaps. That still is very difficult because banks now, big commercial banks, are not as profitable as they were. And in order to recapitalize yourself, you need not to pay any dividends, to retain all that as earnings, not to get into trouble with PPI claims and that sort of thing. And that is very difficult. You look at the profitability of banks over the last 10 years compared to what the Bank of England thought, and it's not nearly as good. So the first question is a practical one. How with the best will in the world, would you recapitalize banks? But then we don't have the best will in the world. We have the bank in a apparently very strong political situation. My view is nothing will happen at all unless there's a really, really big disaster. Okay. We're talking about the collapse of one or two or more big banks, probably the collapse of a couple of insurers as well. If that happens, then possibly there's a sort of 20% chance that someone may listen to Kevin and we'll get a better solution. But I'm not sanguine about the prospects for a resolution.
Yes, it reminds me, I sat on the European Parliament's Economic and Monetary Affairs Committee after the financial crisis. And the answer then would seem to be more regulation. My concern would be that we saw banks and insurance companies go bust. Then they'd sensibly say, oh, we just need stronger regulation. And that's it, without thinking more about, and wouldn't be as radical as what you and Kevin suggested in the paper.
I was part of that. I was part of that as a regulator and within that culture, and that was very much the feeling we need lots more regulation and then everything will be fine. I myself thought that, comparatively recently. Yeah. Recently meaning 10 years ago. I've now completely changed my view on that.
It's funny, when I suggested some of the ideas that Kevin talked about, people just thought I was completely mad and thought I didn't understand finance at all. On that, Kevin, let's talk about some of the let's talk about some of the individual banks, for example. One of the big issues around COVID-19 and the crisis has been increasing concerns. Some of those were pre-existing over China. We're clearly going to have different relationships with China, after the crisis. And HSBC is, exposed to China. Will that have any impact, or might that have some impact on HSBC customers here in the UK?
Well, HSBC worries me greatly because, number one, it is the strongest bank and the biggest bank in this country. It has the strongest price to book ratio, and yet it's massively exposed to Hong Kong. And when you see what's happening in Hong Kong, you see, well, first of all, China is trashing the system, the one country, two systems system, which was the, well, original basis of prosperity of Hong Kong was, of course, the colonial administration, but this is the successor to it, and it has worked well up till now. But the Hong Kong property market is massively overvalued. It's starting to go down. And it doesn't take a rocket scientist to work out that that is a lot of vulnerability. On top of that, you've got all the stuff with China as well as just Hong Kong. So you're talking about one of the most volatile regions of the world, which is essentially where our strongest bank is the most dependent. And to make matters incredibly even worse, is HSBC's policy is to increase its exposure to this most volatile region. So there's a lot of things could go wrong, or put it the other way around. You have to be a terrible optimist not to worry about Hong Kong, HSBC in those circumstances.
Well, look,
sorry, I didn't answer your question about about UK. I think if it comes to it, HSBC will be bailed out. Yeah. It cannot not be bailed out politically in this country.
And we had hoped after the last crisis that never again would we see banks being bailed out with taxpayers' money. But clearly we haven't got that situation. I remember arguing when we had the Bank Recovery Resolution Directive that we still haven't solved the problem. Banks will still expect go cap and hand will expect to be bailed out by taxpayers, and we're clearly not there yet.
Syed, that's the fundamental problem of the political economy of bank regulation, is that the regulatory system, including the political system that's supposed to oversee and control it, is effectively captured. Because the bankers basically, they want to increase return on equity. That means they want to increase leverage. And when push comes to shove, the regulators will always back down. The politicians will always back down. They'll sacrifice a tiny bank that doesn't matter. But any big bank captures the system, basically.
I remember being told by the chief executive of a very large German bank when I suggested that bank shouldn't have to be bailed out with taxpayers' money. And he said, that will never happen. Yeah. So look, it's been a fascinating discussion about your IEA briefing paper, How Strong Are British Banks? Just to round up, Dean and Kevin, but I'll start with Dean. Dean, if you were to go back and talk to your former colleagues in the regulators, and what would be your key message from this paper?
Well, I think they know the key message. It's a difficult one. Perhaps quickly talk about stress testing, because if someone had said a few years ago, well, what if a virus sort of came out of China, respiratory disease, highly infectious, could hit the economy sort of badly? Well, actually, if you think about it, that is quite probable. So it's no use for regulators to say, oh well, no one could have seen that coming, because you could have seen that coming. What I think it would say is, if anyone would listen, and even my ex-colleagues would listen, is get out of this culture of looking at stress tests and then saying, well, that number is a little bit too big and we don't want to impose a capital constraint that the firms can't stand. And that's what they would say. Get out of that mindset. If the number looks big and if it could happen, then it's a big number that could happen, and you need to make sure banks are appropriately capitalized. Don't get afraid of very large numbers and favor sort of very small numbers for your stress. And that's probably, it is so deep in the culture to avoid a proper stress testing of British banks that's the one we need to fix. I doubt it would ever happen. It's not within the culture and psychology of regulators that they would look at real risks.
And Kevin, as you said right at the beginning, you've been concerned for a very long time about the strength of the financial system, about capital adequacy. If someone says to you, "Well, Kevin, you've been writing about this for a very long time, but what's special about this paper? What's your key message in this paper?" What's your answer?
Well, I think the key message is that the regulatory system has failed yet again. We're entering yet another crisis. It could be the worst for a very, very long time, and we are very unprepared for it. The purpose, look, if there's one justification for financial regulation that stands out, I'm not saying that I support it, it is that the regulatory system should exist to ensure the resilience of the financial system. That's the most important function, and it has failed completely, in my opinion. We'll soon find out if we're right, of course.
So on that note, Professor Kevin Dowd, Dr. Dean Buckner, thank you very much for joining us. Can I thank the viewers and listeners for joining us today as well. For more details of our online content, please visit our website, iea.org.uk, subscribe to our YouTube channel, IEA London, or listen to our podcasts on Podbean. And to help us keep providing free content during these tough times, please do consider making a contribution, no matter how modest, by donating online at iea.org.uk/donate-now. Thank you for watching or listening today. We hope that you'll be able to join us again soon.